Hello everyone. Welcome to the Investment Management class. I am Impa Beliappa, Associate Professor, Department of Management Sciences, Maharaja Institute of Technology, Mysore. Previously, in the last class, we have done certain concepts on Unit 4, which is about the charts, types of charts, trend and trend reversals, and we also learned what is the difference between the fundamental analysis and technical analysis. So when you do this, in the previous class when we dealt with the charts, there are 4 different types of charts: line chart, bar chart, points and figures chart, and candlesticks chart. So when we discussed all these concepts, I had told you that there will be patterns in the charts like triangle, flag, hair tops, bottoms, like this. There will be different kinds of patterns. In today's class, we will be learning what are the different kinds of patterns which come in the technical analysis. To know that, let's know what are chart patterns first. Okay, chart patterns means the design which comes in the chart. Some of the patterns are very volatile in the market and some are less volatile, and some are very best suitable for the bullish market, and some are very much used and suitable in the bearish market. And there are 3 categories, like there is continuation pattern, reversal patterns, and bilateral patterns. Like this, there are different types of patterns. When I explain, I will tell you. The continuation pattern tells that it is an ongoing trend which will continue. For example, if the chart is like this, if the trend is going like this with the fluctuations, then we can say it is a continuation pattern, because in the future also the same pattern will be followed. And then you have the second one, which is reversal pattern. Reversal pattern, in the last class only I have explained, it is similar to the trend reversal, where the trend is reversed. It indicates that the trend may change its direction. If it is increasing, if its trend is changing and it is reducing, then we call it as reversal chart, means the trend is reversed. Okay. The next is bilateral chart pattern. Bilateral chart pattern let the traders know that the price could move either way. Okay, in the meaning like the market is highly volatile. You are not sure that whether the prices may go down or may come down or go up. Okay, so we are not sure. That is a bilateral chart. Like bilateral chart, you are not sure of whether the prices may go up or come down. Okay, so that is about the chart patterns. And there are different kinds of chart patterns. Like in technical analysis, we can understand that as there is support and resistance level, head and shoulders, double top, double bottom, rounding bottom, cup and handle, wedges, pennants, flags, ascending triangle, descending triangle, symmetric triangle. Like this, there are different kinds of patterns. So while listening to it, you may find there are a lot of different types of charts, but now individually we will discuss each type of chart. Okay, starting with the first one, support and resistance chart. Support and resistance chart, I have already told you about this. This is, it refers to the price levels on the charts which tend to act as a barrier preventing the prices of an asset from getting pushed to a certain direction. Okay, and that is about the resistance. And support is if the prices are in a downtrend, then either you need something to lift the prices upwards, where there is an expectation due to the concentration of demand and buying interest. The price of the assets or securities drop, demand of the shares decreases, forming a support line. So support is given normally when a person falls, they need support. Okay, but whenever a person is growing, there will be few people who want to put them down and suppress and resist them from getting success. So pushing downwards is resistance and pushing upwards is support. Okay, so here resistance zone arises normally due to the selling interest. Okay, if people are very much interested in selling and there is more of supply in the market, then you need to have the resistance level. So here if I see, you can see the chart here also. There also you can see the support and resistance level, how when the prices come down, you support it in order to push it upwards, and in the same way when the prices come down, when the prices continuously increase, there is a kind of resistance in order to push the price down. So to draw it in a simple way, if we draw any graph like this, okay, at this level you need resistance so that the prices should come down, and at this level you need support in order to lift the prices upwards. Okay, so this is about the support and resistance level. Coming to the next, which is head and shoulders. It's not a shampoo. Okay, head and shoulders is a kind of pattern which is formed in technical analysis chart. Okay, here head and shoulders pattern, which is like large peak in between, and similar they have smaller peak like this, head and shoulders. Head is the top peak and there are two shoulders on the either side of the head. That is known as, that forms the pattern, and it is known as head and shoulders pattern. So traders look for this kind of pattern in order to predict whether the trend will be bearish or bullish, or whether there will be reversals in it. And normally the first and the third peak will be the smaller one when compared to the second peak, because this is at the high, So once it falls back to the same level, it is understood there is some support which has been received, and definitely the prices will go up. And you can also known as the neckline. This neckline will help you out to predict what is the next trend which is coming. Okay, so whenever it is falling, they need support. Whenever that is at the peak, you need resistance to break out the trend. So in this type of pattern, where if you, for example, there is, as I've told you, there will be no particular way where I can say, yes, this is head and shoulders. But in the regular trend, you have to identify where the head and shoulders is there. Okay, traders look at head and shoulders in order to predict the bullish or bearish trend. Okay, so here you can see the chart here where the green and red candlesticks is representing the head and shoulders, where head is there on top and shoulders are there, and there is a neckline. So if you have to see, if there is a simple price like this, it is raised and then like this, then this pattern here you can see and identify the pattern that this is head and shoulders. There is a peak in the first one, and then there is the highest one, and then the third is slightly smaller. So this is an example of head and shoulders. So there is head and shoulders in the chart. Okay. Hopefully you have understood this. Let's move on to the next one, which is double top. Okay. Now what is this double top? Double top is another pattern where the traders use and highlight the trend reversals. Okay. Typically whenever the asset price will experience a peak before retracing back to the level of support, then it will climb once more before reversing back the trend more permanently, that is preferably against the prevailing trend. Whichever prevailing trend is there, it will move against it. So here double top, there is top pattern. You can identify this as top pattern, and there is double top pattern also. I'll show you how a double pattern top looks like. You can see the chart which is displayed here also. There also you can identify that there is double top, means the prices nearby are similar in that range. So if you have to say that like this, then you can identify top 1, top 2 where you have double top. Okay, hope so it is clear. The trend where the tops are nearby together, having at the same level, that is double top. Okay, next is just similar to this, double bottom, not the double top. Now it is a chance of double bottom. Now what is the double bottom? Double bottom is a chart pattern which indicates the period of selling causing an asset's price to drop down below to the level of support. At that point of time, you definitely need certain support to lift the prices up. Then it will raise to the level of resistance before dropping it again. Finally, when the trend reverses and begin to an upward motion, the market becomes more bullish. So, the double bottom is a bullish reversal pattern. Bullish reversal pattern means it's more suitable to predict the bullish, so that where it reverses you are able to identify, because it signifies at the end of the downtrend and a shift towards uptrend. It signifies the downtrend shift towards uptrend. So I'll just continue this and show you. If it is like this, then we can say it is double bottom. Okay, double bottom. It means that after the double bottom, it will definitely raise in the prices, which is nothing but signaling its upward movement. So it is a kind of bullish trend, bullish reversal trend. So you can see this and predict and understand, yeah, this might be the chance where you can buy the shares. Definitely it will go up in few days. Okay, and then next kind of pattern is rounding bottom pattern. Now, what is this rounding bottom pattern? Rounding bottom pattern can signify a continuation of a reversal, like it is in the same pace. For instance, like during the uptrend of an asset, price may fall back slightly before raising once more. Like before it raises upwards, it will fall back. This would be a kind of bullish continuation. Okay. Here, if you have to take an example of bullish reversal rounding bottom, then the asset prices will come on a downtrend in the round shape form because of the trend. Here you can see the chart where a round form is formed of the trend reversal and enter into a bullish uptrend. Once you finish that round reversal, it is uptrend, going upwards. Traders will seek to capitalize on this pattern by buying halfway round of the bottom. Like when it is, I'll show you first what is the round reversals. If this is the chart, I'm not drawing the OX axis and OY axis. I've just slightly put this. As you all know, OX axis simplifies the year or months and days, and whereas the OY axis simplifies the volume or prices, that you know. So I'll not specify always, so because I keep on changing, I'll put all in one chart. Okay, so if it is, you can see the chart here also, but if I have to explain that, okay, see here, this is rounding bottom. Okay, rounding bottom. Here you can see that once they normally buy it halfway around, like whenever they are halfway around the bottom, that is at the lowest point, they buy it and wait until the round bottom completes its cycle, and when the share prices move up with a breaking the resistance up to the level of resistance, they move. Okay, so most probably you have understood. This is rounding bottom. So rounding bottom, halfway around, it will be continuously deteriorating, and it will, when it reaches, it is reversal up into upward trend. Clear? So this is another type of what are all the types we have discussed. I'll not write there. Later on we might need, so I'll write here. The different kinds of charts we discussed were, the first one we discussed was support and resistance chart pattern, support and resistance. Then we discussed the head and shoulders, so head and shoulders. Then we discussed the double top, so double top, and then we discussed the double bottom. We discussed the double bottom, and then we discussed the rounding bottom. I'm writing here so that at the end it will be very easy for us to consolidate what we have discussed in today's class. Okay, so these chart patterns we have discussed, and another chart pattern. Okay, another chart pattern is cup and handle. Okay, now what is a cup and a handle? Normally, nowadays you normally have these steel cups, but if you have this crockery set, you hold a cup like this. You have a cup and a handle to hold that cup. If that is a kind of pattern which you get in the technical analysis charts. Okay. Now, what is this cup and handle pattern? Cup and handle pattern is again a bullish continuation pattern. That is when they used to show a period of bearish market sentiments before the overall trend finally continues with the bullion motion. The cup appears similar to have the rounding bottom pattern, the same rounding bottom pattern chart, and the handle is similar to the wedge pattern. Like wedge pattern, I'll tell you next what is a wedge pattern. Wedge pattern which is explained, which I'll tell you, okay, which will be explained. So, following this rounding pattern, the price of an asset is slightly low to an temporary retracement, and then which is known as the hand, it will reach the handle because the retracement is confirmed to parallel lines like this. If I have to show here, you can see the chart of it, which is practically put of the candlesticks again, where you have a round trend and trend reversal, and then you have a handle for it. If you have to practically draw it on spot now, this is the rounding bottom, and so this is the handle. Like you hold the cup like this and sip a cup of tea like this. Yeah, so that is the cup and handle formation. Okay, here normally they land in the two parallel lines. The prices will be fluctuating, and the asset will eventually reverse out of the handle and continue to the bullish trend. So this is the handle. After the handle is done, it is into the bullish trend. Clear? This is cup and handle pattern. Okay, so we have done with cup and handle pattern. So I've told you about the tops and the bottoms, and this also you can include the top and bottom. Let's move on to the next one. Okay, which is the next kind of chart. I told you, no, I'll tell you about the wedges. Now I'll do wedges itself. Okay, wedges. So what are these wedges? Wedges of an asset, like of as an asset price movement, tightens the two sloping lines. It tightens between the two sloping lines. If the two sloping lines are like that, then it tightens it. That is called the wedges. There are two types of wedges: raising wedge and falling wedge. You can see it in the chart here. There is raising wedge where it is raising and you need some resistance to put it down. That is raising wedge. Then you have the sloping wedge, whereas the prices are sloping down and you need support to push that prices upwards. Okay, so there are two types: rising wedge and sloping wedge. A rising wedge is normally representing a line, or that is trend line caught between two upward slant lines. Okay, it is moving upward and slant. It is caught between those two. That is rising wedge. Okay, in case of line that supports the steeper than the resistance line, this pattern generally signifies the asset price will eventually decline more permanently, which is demonstrated when it is breaking through the support level. If it is breaking through the support level and moving downwards, so it is understood that it will stay in that particular position for a longer duration of time. That is wedges. Probably you have seen the girls wearing wedges slippers, which will be flat like this at the bottom, from the toe to the end. Okay, so that is wedges. So here I'll just draw one example of wedges where starting parallel lines will be there like this. You have the parallel lines, and sometimes to need the prices to up, you need a support level. Okay, and then you in order to lift it, once it is reached the peak, you need resistance. So this is like an example which I've put in the chart. Okay, so these are wedges. Okay, so this is one of the pattern, that is wedges, and after wedges you have one more pattern which is about the to continue this. If I have to continue the rising wedge, I have told falling wedge also like has two downward sloping levels in which the line of resistance is steeper than the support, and the falling wedges is normally indicative that the asset prices will raise in the breakthrough and the level of resistance will be shown as a sample. Okay, it will raise some or the other day. It is that kind of situation. So both rising and falling wedges are reversal patterns, with rising wedge representing bearish market. So rising trend, you can see here, rising trend, it is like a bearish market where it increases, but in the hope that it will come down. Okay, then and falling wedges are more typically of bullish market, that after the falling wedge it is definite that the prices will go up. Okay, this is about the wedges. Next is next kind of chart pattern, pennants or flags. Okay, next kind of pattern is pennants or flags. Pennants pattern or flag pattern are normally, you know how a flag is, you will have seen in what shape the flag is. In that shape the pattern is formed. That is the reason it is called pennant or flag shape. It is created after the asset experience a period of upward movement. So normally if it is having a continuous period of upward movement, then we call it as pennant or flag shape, followed by a consolidation. At the last it is like consolidation. Generally there will be a significant increase during early stages of the trend before it enters into a small upward and downward movements. Okay, like they have these large upward movements, and these upward movements slightly become narrow down. Okay, pennants can be either like, it can be used either in bullish market or bearish market. They can represent a continual or a reversal. Okay, the above chart, like the chart which I have taken, this explains the bullish continuation, where after that the prices have continuously increased. So it represents a bullish continuation. And in this pennant can be formed with bilateral patterns. I told, no, bilateral patterns is where you're not sure whether prices will come down or go up. Okay, so that is also possible. While in pennants it is quite similar to wedges. Okay, wedges and pennants are quite similar, or this is similar to triangle. Triangles I'll do next. Okay, so where wedges are narrow than pennants. Okay, they are narrow like this, whereas pennants are in a broader sense. Okay, wedges differ from pennants because a wedge is always ascending, descending, while a pennant is always horizontal. Okay, so I'll show you how a pennant or flag shape is there. If this kind of shape is formed, where it is a kind of flag pattern, then we call it as pennants or flags. So this is also one of the form of chart patterns, pennants or flag. Oh, I've already written. Okay, pennants or flags. Next kind of pattern are triangles. Okay, I'll write here triangles. There are three kinds of patterns in triangle: ascending, descending, symmetric. Okay, ascending, descending and symmetric. All in one chart. I'll just show you what is ascending triangle, descending triangle and this symmetric triangle. Okay. Now what is an ascending triangle? Ascending triangle is it's like a bullish continuation pattern, and which signifies the continuation of an upward trend. We hope that in ascending triangle, normally what is ascending order? We have learnt it in our school maths. So ascending order is where the numbers keep on increasing, like 1, 2, 3, 4, 5, 6. This is an ascending order. Okay, if it's not continuous, we'll say 1, 5, 10, 15, 20 like this. It is ascending order. Okay, it keeps on increasing. The same thing happens here too, where the triangle is formed in an increasing pattern. Okay, then ascending triangles they are drawn into charts like tracing an horizontal line along with the swing height and the resistance, and the drawing the ascending trend line along with the swing lows. Okay, so it is like a support, and like if it is swinging low, then it is support because you have to push it upwards. If it is swinging high, then you need resistance to push the prices down. Okay, ascending triangle often have 2 or more identical peak highs, like they have similar kind of peak highs, which allow for the horizontal line to be drawn. So if you have to draw an horizontal line like this, you need 2 peaks, right? So that kind of peaks is available, and trend line signifies that overall uptrend of the pattern, while horizontal indicates the level of resistance for a particular asset. Okay, if I have to put that, like this, it is an ascending triangle. Okay, the opposite of this, you can see the chart here also. The opposite of that is the descending triangle. Now, what is a descending triangle? It is similar to the descending order. Like you have 80, 75, 70, 65, 50, decrease in number in the same way. Descending triangle signifies the bearish trend. This signifies the bullish trend because the prices will continue increasing, whereas the descending triangle, it is signaling the bearish continuation in the trend. Typically, when a trader will enter into the short position during the descending triangle, he'll possibly have these cash flows and attempt to profit will in the falling market. Okay, descending triangles generally shift from lower break through the support because they are very much inductive in the market and dominates the sellers, where the successive lower peaks, they have similar lower peaks, so that they have a line like this which is prevalent, and then they take a reversal into the bearish. It means that they will continue with the bearish continuation. Okay, descending triangle can be identified from the horizontal line at the support and a downtrend sloping line of the resistance. Okay, from the resistance it will be downward sloping, whereas at the support it will be constant. Okay, so here if I have to say, they'll be having more of lines like this, where see, this is where you get see, this is where you get the descending triangle, a downtrend, where almost you have similar kind of bottoms, and continuation of the bearish is quite similar to happen. Okay, so and the resistance level is sloping downwards. If that is the case, you can see identify the difference between ascending and descending, where this is descending triangle. Ascending triangle would be, I'll just draw in the So ascending triangle would be like this. The tops will be common and the bottom will, that is the support level, will raise to the peak. Okay, so that is ascending and descending triangle. Okay, next when we come to the, we have finished ascending and descending, let's see what is a symmetric triangle. So symmetric triangle is the in-between position of these two triangles. The symmetric triangle pattern can be either bullish or bearish depending on the market. Okay, in the either case it is normally the continuation pattern, which means the market is usually continuing in the same direction in which the overall trend or pattern has moved. Symmetric triangles form when the price converges with the series of lower peaks or higher trough, where if you have to see the example of chart which we have put here, you can see that there is a lower highs and then a higher lows. So they both meet at a point, which is the perfect example of a triangle. So we call it as symmetric triangle. And but the symmetric triangle shows us that there are been a brief period of upward reversals also. So if I have to draw an symmetric triangle, so you have a line like this and they both meet in the center. Okay, they both meet in the center. That kind of triangle, we call it as symmetric triangle. You can even see in the chart which I have put, and there is no proper continuation of it, which is nothing but the bilateral pattern. It may go up or it may come down. You are not sure of. That is about the symmetric triangle. So symmetric triangle is a combination of, you can say, all kinds of triangle, that is ascending and descending. There is a common point at which they meet. Okay, if there is no clear trend before a triangle pattern, the market should break through its either direction, like it might be symmetric triangle bilateral pattern, where just now I explained, no, either it can increase or it can decrease. Okay, the movement might change. Okay, that also you can see in the chart which are put. So normally when we say bullish market, the prices are high, the closing prices are high, the opening prices are high, the low prices, opening price and will be low, like opening price will be low price, and whenever you end the market, whenever you, this candlesticks only I'll put, whenever you end the market, it will be high price, like closing price will be high price. Opening price will be the low price and closing price will be the high price. If you have to say bearish, normally bearish we signal it in the form of red color. So in this red color, if you have to say bearish, it is vice versa. Okay, like opening price will be the high price, opening price will be the high price and closing price will be the low price. Okay, so probably you have understood this. Whenever we say bull market, bull, and this is bear. Whenever we say bull market, the prices of the market, opening price will be low and closing price will be high. Whenever we say bear market, opening price will be high and on that particular day the closing price will be low. That is bull market and bear market. So this is about the trend, how it moves. So to consolidate what I have done today, in today's class I have discussed about the chart patterns. Okay, the chart patterns involves the different kind of chart patterns, like you have support and resist level. Support and resist level, when the prices come down, you needed support to push it upwards, and when the prices completely increase, then you need resistance levels to push it down. Then you have head and shoulders. It's a pattern where which is quite similar to our body part, where you have neckline and there are shoulders and there is head. There is a small peak first and then a bigger one and then again a small peak. Then we have tops and bottoms. If it is top and bottom, then if it is, the shares are like this. then top pattern, and then you have bottom pattern, then you have double top and double bottom. Then you have rounding bottom in a circular way. Then you have cup and handle. You have a rounding bottom and then a line like this, like to hold a cup, like handle formation. Then we have wedges. Wedges is quite similar to the previous one, where you have the different kind trending upwards or downwards. That is wedges, a similar parallel line shaped form. Or you have pennants or flag pattern or pennant pattern. Then you have triangle. In triangles you have ascending triangle, descending triangle and symmetric triangle. Okay, ascending triangle is where the common tops are there, you get a straight line, and then the support level moves upwards. Descending triangle is where the support level is constant and resistance level has a downtrend. And asymmetric triangle is where both of the support and resistance level meet each other. Okay, then how the difference between bull and bear market, why we say bullish trend and bearish trend. Bullish trend we tell because it is the opening prices are low and closing prices on that particular day will be high. We say bearish because opening prices will be high price and closing prices will have low prices. So this is what we have discussed in today's class. Hope you have understood. If you have any kind of confusions when I play it in the class, you can ask me. Okay. Thank you for listening to today's class.